We had a very good second quarter of 2023, where both of our funds actually performed very well. And as you very well know, we have a Mansa-X Kenya Shilling Fund, and we have a Mansa-X Dollar Fund. For the Kenya Shilling Fund, we returned 4.7% for Q2, and for the Mansa-X Dollar Fund, we returned 2.8%. So that brings our first half performance to 8.69% for the Kenya Shilling Fund, which is an annualized return of 17.38% after fees. And for the Dollar Fund, the first half return, the actual return comes to 6.19%, which is an annualized return of 12.38%. So we are very happy about that return, because it means that the fund is performing reasonably better than most asset classes locally. If you look at a 17.3% return in a Kenya Shilling Fund and 12.38% return for a Dollar Fund, I think we can say those are reasonably good returns for any fund. Our assets during that period as well grew well. We can talk about the Kenya Shilling Fund, where we grew from 13.3 billion at the beginning of the second quarter to close the first half at 15.3 billion shillings. That's what we actually have assets under management for the Kenya Shilling Fund. For the Dollar Fund, we started the second quarter at $6.3 million and closed at $10.2 million. So in terms of growth, in Q2, assets under management for the Kenya Shilling Fund grew by 15% and grew by 63% for the Dollar Fund. So just speaking to the Shilling Fund, we like to compare our fund to, at the moment, to T-bills. I think that's the most comparable asset class, and I'll explain why. We've had a lot of investors asking us, why don't you compare your returns, say, to IFBs? Because if you look at the IFB performance, we had close to 16% coupon rate for the most recently issued IFB. Our argument is, for you to actually achieve or earn that return of about 15.87%, you'd have to hold that paper to maturity. But within Mansa-X, you're getting a return of 17.38% net of fees, and you can access that yield anytime you want. You can withdraw your funds anytime and still have that return on your investment, which is why we still feel that comparing our fund to IFBs is not necessarily the correct thing. Maybe you can compare to shorter term papers like treasury bills, which are now returning about 12%. So it's a fairly liquid instrument, just like based on the tenor, but again, returns about almost 5% less than what a Mansa-X investment is actually giving you. And that, for us, is really proof that Mansa-X continues to deliver above average returns. The same argument can be used for the Dollar Fund, where you have a return of 12.38% in your dollar investment in the Mansa-X Dollar Fund. And we've had people asking us, with Euro bonds yielding about sometimes as high as 15%, why is your fund better? Our argument is, first of all, it's very volatile. That yield is rarely static. You can have 15% shift to 11% within weeks. Number one. Number two, you'd have to have a much higher investment there, about $200,000 as a minimum investment in Euro bonds. So in Mansa-X, we are allowing you to participate in a very high yielding fund with only a minimum investment of $2,500. And again, being able to access that return at will, because we really don't have redemption fees on our fund after our lock-in period of 6 months. So we still feel that an investment in the Mansa-X Dollar Fund still beats most dollar funds out there that we know of, or any other dollar investments out there. Our performance in Q2 was really an extension of our trading strategy from Q1. We've seen a bounce back in the stock markets globally, and we took advantage of that. And I think I'd mentioned this in our last video at the end of Q1, that we expected a continuation of the same dynamics we saw in Q1 into Q2, and this has actually proven to be correct, especially when you look at how growth in the stock markets was driven by a rally, especially in the tech stocks. In fact, you can say that the tech stocks contributed to over 30% of the reason why the market was actually trading higher in Q2. If you look at our fact sheet, we've actually nowadays we actually include our top 10 positions, and we try to give the weightings that we actually used during that period. And I'll just go through them very quickly. We had significant positions in the dollar, where we expected that the dollar will gain against most currencies, or would rather we expected that it will continue to gain against other currencies, which actually happened, with the dollar gaining about 0.3% during that quarter. We were also heavily invested in Eurobonds. We trade Eurobonds very much on a speculative nature here, and we've been able to squeeze out very significant returns out of trading these Eurobonds. So these Eurobonds are typically African Eurobonds, but really biased. We are really biased on Kenyan Eurobonds because we feel we have a lot more information how to trade those. From a commodities perspective, we were holding natural gas positions. We saw natural gas jump by about 25% during the second quarter. We saw sugar gain by about 2% again during that quarter again. And commodities is also something that we hold significant positions in. For tech stocks, this was a very interesting quarter to watch. Some stocks such as Nvidia gain over 50% during that period. But our specific positions were actually in stocks like Apple, which grew by about 17%, ASML by 6.5%, and Adobe by about 27%. That really touches on what we were trading in the Kenyan Shilling Fund. The dollar fund, the positions were very similar. I think the only tweak is we were holding some positions in TSMC, which is Taiwan Semiconductor Manufacturing Company, Microsoft, and Qualcomm. Microsoft specifically jumped almost 20% during that period. In the dollar fund, we also had positions in gold, which lost about 2.5% in that period. Also, we had positions in the dollar and also specifically in the euro as a currency, which jumped about 0.67% during that period. Again, I'll emphasize some of these positions can be short positions. So like when I mentioned gold, that's actually a short position where we expected gold to lose value. And also when I mentioned like the German bonds, where we actually expected that yield would jump, meaning the price of those German bonds would actually go down. So you make a return from this by actually being short those German bonds. And during this period, the yield for German bonds went up by about 5%. Again, meaning that the price would then drop. But again, higher yields in a lot of these bonds have created opportunities moving forward to take very interesting positions because I think these are some of the highest levels we've seen for most global fixed income asset classes. So as part of our diversification strategy, other than just investing in various asset classes, we make sure that our assets are distributed across various geographical zones. In fact, if you look at our current fact sheet, which we made a few changes to, and I hope our investors are going to appreciate that, we actually included where a lot of where our assets are actually invested in and where they're located from a geographical perspective. For the Kenyan Shilling Fund, our biggest geographical zone was actually the Americas. A lot of our companies that we invest in, whether it's through the stock indices or through single stocks directly investing in companies, were mostly American companies. The second largest concentration geographically are European companies and European assets, whether it's fixed income like with the German bonds or stocks like ASML and Musk. Those are European asset classes. The third largest concentration geographically is Africa, where we trade significantly, we trade Eurobonds, and specifically mostly Kenyan Eurobonds. But we also have Oceania. That's where we have currencies like the Australian dollar and the New Zealand dollar. And then recently we've started investing in Asia, where we have positions in companies like the Taiwan Semiconductor Manufacturing Company. We also invest in currencies like the Japanese yen and in indices like the Hang Seng Index. So that's for the Kenya Shilling Fund. The Dollar Fund, geographical distribution is not so different. We still have Americas leading the concentration. The only difference is that because we found a lot of value trading Euro bonds, Africa then came second in the Dollar Fund, but we also have again the same ranking again with Europe, followed by Middle East and Asia, and then a very small portion going to Oceania regions. Again, the reason we do this is really as part of diversification is not just the assets, again, just to repeat, but also where these assets are domiciled. For the second half of 2023, I guess one of the key things to note is that we've had a very interesting first half of this year, with the S&P jumping 16% and the Nasdaq moving almost 40% higher from where we started the year. Those are very significant moves, and of course, for us as your portfolio manager, I'll be very concerned about should we be more cautious moving into the second half in terms of how many positions we take in these markets. But I guess the biggest factor for us and the things that we look at are really how much optimism is in the market. If we look at currently, we have a lot of optimism in terms of company earnings. In fact, a lot of companies have actually revised their earnings expectations upwards, and a lot of this data will be flowing in. By the end of this month, we'll have known how companies have actually performed for the first half of this year. So this will really help in guiding us to know how to reorganize and restructure our portfolio for our investors moving forward. There'll also obviously be concerns around how central banks, especially the Federal Reserve, are going to treat interest rates. We still believe that they'll have two more rate hikes, and we believe that there will be an aggressive one actually this month again. So this month becomes very important in helping us guide our strategy moving forward. Of course, there are recession fears. This has been a fear that has been on everyone's mind since the year began. And the fears are increasing mostly because if you look at the yield curve inversion, and this is in the United States, where the 10-year bond yields are actually trading lower than the 2-year bond yields, which implies that investors out there are expecting that near term, the Federal Reserve will be increasing rates aggressively to fight inflation. But investors at the same time are then factoring in that aggressive rate hike could create a slowdown in the economy, necessitating the Fed longer term to cut rates. So typically that's what you call the yield curve inversion, and we actually measure it by just checking the yield of the 10-year versus the yield of the 2-year, and we are at levels at the highest level since 1981 in terms of that yield curve inversion. Again, this has historically been a signal that a recession might actually be on the horizon. But on our side, we'll continue to be just cautious, as we always have been, and as we always tell our investors, whether markets are gaining or losing, because it's a long-short fund, as long as we are well positioned based on available data, we will still make a return for our investors. Locally, we are seeing renewed interest in our local market by foreign investors, most likely due to the fact that fears around accessibility for dollars has actually reduced somewhat. So we expect that the Nairobi All-Share Index might actually start rising in the second half of this year. We saw it lose value in the second half. Actually, the second quarter, it lost about 5%. Again, if you had fully invested in the Nairobi All Shares Index, you probably have lost about 5% of your investment during that period. But we believe that in the second half of this year, those losses will actually be reversed, and we'll see a better performing stock market. In terms of interest rates locally, we feel that the kind of the kind of aggressive rate moves that we saw, say, in 2016, we will not see them this year. We believe that the current central bank has aggressively raised interest rates quickly enough to just manage inflation the best they can, and to actually anticipate a rise in inflation. So we actually believe we might actually see an inflection point in terms of interest rates, and we probably are seeing the highest interest rates locally that we have seen yet, and we believe that we'll actually see interest rates start to normalize into the second half of this year. As part of our innovation at SIB, one of the things we do is really listen to our clients. Just going back to how we started Mansa, we started Mansa because our clients wanted to have a product that allowed them to have a return, whether local markets were doing well or not. That's why we created Mansa, which is a globally focused investment fund. But one of the other questions we've gotten from some of our clients is, why don't you create something that caters to the Muslim community? Because a lot of our clients and potential clients are actually Muslims. For this reason, we have recently created a product called Mansa-X Sharia. So moving forward, we'll also have Mansa-X Sharia, and we'll have a Kenya shilling version of it and a dollar version of it. And we hope that this will be able to give our Muslim brothers and sisters out there comfort that we have listened to their plea for an investment product. And we believe that it will still be the kind of fund that will still offer above average returns while still complying with Sharia compliance laws. So I'd just like to underscore that Mansa-X, by its very design, is a very dynamic fund, meaning that the fund itself, other than just the various asset classes that we invest in, which means we have very good diversification, the approach to those asset classes is also very unique. For example, we are one of the few funds that can go, short assets, meaning whether markets are gaining or losing, we can make money when markets are losing value or when they are gaining value. This is very important to note because it's what allows us to have consistent returns. We've had investors wondering, how do you make returns even when markets are actually not performing very well? So that's one of the reasons. The second reason is the fact that we spread out our investments across various geographical regions, and that's why if you look at the fact sheet, that's one of the things we included this time. Again, that speaks to our ability to then tap into various markets and take advantage of the unique attributes of those various markets. Sometimes we will be in African markets, sometimes we'll be in European markets, sometimes we'll be in American markets, and this allows us at any one time to quickly take advantage of the uniqueness of those markets. A good example is how, if you look at our fact sheet this time, you'll see that we are now starting to create exposure to Asian markets, something that we have not done much of before. So again, this is one of the reasons why, as an investor in Mansa-X, you should have a lot of comfort that your returns remain reasonably consistent, because there's always a very innovative way in which we continue to restructure and rebalance portfolios based on the various markets that we can access and the various assets that are domiciled in those geographical regions, or different assets that we can actually buy or sell on the behalf of our clients. So finally, we would like to thank our investors for believing in Mansa-X as a product and believing in Standard Investment Bank as a fund manager. We've seen tremendous growth of the product. We now manage about 17 billion shillings in assets under management. And this is really purely because of the enthusiasm and steadfast belief that we have from our investors. We just want to assure you that if you have any support that you require, because we've also gotten a lot of questions around financial advice, just from existing clients and potential clients. Example being clients asking us about rules around topping up, questions around how they can reinvest their profits in Mansa-X, questions around whether their return is affected if they withdraw their interest, and what will the best time to withdraw their returns, and so on. We want to assure our investors that we have a lot of financial advisors ready to pick up the phone and guide you through these questions. And don't shy away from asking any question. No question is too small for our financial advisors to guide you through. So we have social media handles that are displayed on the screen. You can access us through those handles, and also you can write emails directly to us on clientservices@sib.co.ke. So once again, thank you very much for believing in Mansa-X, and hopefully you will invest a lot more in the second half of this year as you continue to create wealth for yourselves. Thank you.